Tesla, Tesla, Tesla. 2020 was full of headlines about Tesla, from it becoming the world's most valuable automaker to its inclusion in the S&P 500, to its 5-for-1 stock splits, to its CEO Elon Musk becoming the wealthiest human on the planet. But what does 2021 have in store for Tesla?
We're going to go through the complete intrinsic value calculation for Tesla, who, for most of the company's history, has been operated in the red. So stay tuned for our valuation and our discussion on valuing businesses that have negative earnings.
Hi everyone, I'm Sam.
And I'm Chris.
Thanks for tuning into our channel where we explore achieving wealth and financial freedom through a 3-part strategy.
Earn more, spend less, and invest the rest. So first and foremost, Sam's back. Yay!
Yay!
But to be honest, I barely missed you.
If that was true, there wouldn't be 35 empty kidney bean cans in the trash right now. Whenever we are looking at an investment, we always ask ourselves the 4 key questions. Do we understand it? Does it have a durable competitive advantage? Is the management honest and capable? And can we buy it at a discount to fair value?
In this video, we're going to go through the complete valuation process for Tesla by answering those 4 questions. Tesla is a little bit different than most of the companies we look at because for most of the company's history, it has had negative earnings.
This makes answering these 4 questions even more important because we can't rely on the past to paint a clear picture of the future. All right, let's get grooving with question number 1. Do we understand Tesla?
Well, it's an auto manufacturer who makes electric vehicles. Tesla started up in the early 2000s with funding primarily from Elon Musk. It has grown to include other clean energy products through internal development as well as acquisition. It is a company that has a high amount of vertical integration, which means that much of its necessary supply chain is actually provided by Tesla itself. It is the company that you think of when you think of electric vehicles, and it currently owns 23% of the market share of that sector of the automotive industry.
So we understand buying and owning vehicles. We know who they're competing with, and we know where they fit in within the automaker biosphere. And most important, we understand how they make money. So when it comes to understanding it, we feel pretty confident that we have a good enough idea, and we're also confident that if there's anything that we have doubts about, with a little research, we can clarify those doubts and feel comfortable understanding what's going on within the business. All right, so let's check that box and move on to question number 2. Do they have a strong, durable, competitive advantage?
Now this is a tough one for us to answer because we've never owned a Tesla, nor have we ever known anybody that's owned a Tesla. Though they are a well-recognized brand when it comes to electric vehicles. They are a growing company in the electric vehicle sector of the industry, but will they be able to hold on when more notable manufacturers start to focus on the electric vehicle market? That's the question you must answer if you are going to invest in Tesla with confidence. From the research I've done on Tesla, its batteries are one of the main competitive advantages that it currently has because they are considered better than the competition. Tesla has partnered with Panasonic to develop these batteries, and they've also partnered with universities and research centers to continue the development of batteries. They have whole divisions on energy storage, and they spend a lot of money on research and design into battery design. Like I said, they are a company that has a lot of vertical integration, so they focus on each part of the car, not just the car as a whole.
Still, I have concerns about Tesla when it comes to the electrical vehicle market. Are they going to be able to hold on to their market share as more experienced automakers enter into that space? This is a red flag for me. It doesn't mean that you can't invest in Tesla, but what it does mean is that you need to have extreme confidence that they are going to be able to hang on to what is theirs as we move into the future and other people enter into this niche market. We're not 100% sure if they're going to be able to do this. So essentially, we've now reached a point where we're at a crossroads and we need to make a decision. Are we going to continue to dig in deeper, or are we just going to say, let's take a pass on investing in Tesla? Now, for the sake of this video, we're going to go ahead and move forward because we want to walk you through the entire valuation process. So let's just assume that we are confident in the information that we found and we're ready to move forward. All right, let's talk management team. Are they honest? Are they capable? And how would we even know? Well, as far as capability goes, we like to look at 3 key metrics: return on equity, return on invested capital, and the debt ratio. For return on equity and return on invested capital, we're looking at those to be at around 10%. And in terms of debt, we want to see that they will be able to pay off their debt by using a couple of years of their earnings. Now, if we dig into those numbers for Tesla, it doesn't look very good for them. Now, they are a relatively new automaker as far as automakers go, and so they're still in a period of extreme growth. But the truth is, they have been around since 2003, and they have not had a profitable year until 2020.
So this is a red flag, and you need to be very optimistic about Tesla's future to be okay with this one. If they can't maintain or grow their market share, or they struggle operationally, they won't be able to pay down their debt, and this will weaken their balance sheet, putting them in all kinds of risk. Remember, we look for companies that are going to earn a high return on our money, and so far Tesla hasn't shown that they're going to be able to do this. Looking at Elon Musk, I have mixed feelings about him. I love that he goes after big, audacious goals, especially ones that I feel will benefit humanity. But he is a bit erratic, and although he is building sustainable cars, he hasn't proven to us that he has built a sustainable, profitable business in Tesla. Now, a great way that you can learn a lot about a company's management is by reading their shareholder letters, which you can usually find on the company's website. Also, you want to check out interviews that the CEO, CFO have done in the past. Now, with Tesla, and Elon Musk in particular, he is a very active Twitter user. So you can go onto his Twitter feed and see all kinds of thoughts that are coming out of the Tesla CEO's head at the moment.
Mm-hmm. And when it comes to reading these shareholder letters, what we typically like to look at is a time span of 10 years. We start with the letters from 10 years ago and we read them chronologically up until we get to the point where we're at today. The things that we're looking for in the letters is we want to see what kind of targets the CEO has hit and if they actually achieve those targets or not. We're also looking to see if they are the kind of person who is going to take accountability for when things go wrong in the company and the kind of person who doles out and gives praises to their employees for the good things that happen at the company.
Yeah, a great example of this, if you want to see how a CEO can do this well, is read the Berkshire Hathaway annual letters that are written by Warren Buffett. He is fantastic at taking responsibility and also giving praise.
Okay, so we understand Tesla and how they make money. We have a few questions when it comes to whether they have a durable competitive advantage, and we have some red flags when it comes to our assessment of the management. So right now, it's not looking good.
No, not for us. But again, this is where you need to decide if you're going to throw in the towel or dig in deeper. So we're going to assume that we dug in deeper and are satisfied with the answers to the troubling questions that we found.
So we'll continue on to question number 4. Is it priced at a discount to fair value?
So with any valuation, we're trying to predict the earnings or the cash flow that the investment will produce over the next 10 or 20 years. Usually we use past performance to help us make this prediction. But in the case of a company that has negative earnings, like Tesla, we're unable to do so, and this makes this prediction very difficult. This is because your prediction is now relying on the idea that the company will do something differently than they have done in the past. So you need to be extremely confident in the catalysts that are going to make this a consistently profitable business.
To evaluate Tesla, we will use the margin of safety method that we learned about in Phil Town's book, Rule 1. Now, if you're new to investing, this is our #1 book recommendation, so we will link it below in the description.
So specifically when valuing companies with negative earnings, we want to know if the negative earnings are an outlier. So let's go over to Disney stock, who is a clear example of a company whose last year's negative earning result is an outlier. So I'm now on Excel and I have copied over the last 10 years EPS results for Disney. What you will see is that when plotted on a chart, last year's negative result was a clear outlier. When you have an outlier, you want to dig in and understand what the cause was. With Disney and its 2020 result, it's pretty easy to understand why it happened. COVID-19 hit a lot of companies very hard, and Disney was no exception. Even though Disney has diversified income streams, a large percentage of their revenue still comes from theme park attendance. And their theme parks were closed or operated at reduced capacity for most of the year. And this is what led them to a negative earnings result. Okay, so now that I've determined that the 2020 negative EPS was an outlier and I understand why the outlier occurred, I'm actually going to jump back over to the chart and remove it completely. So I'm just going to come over here and delete that data point so that it doesn't disrupt my my analysis. Okay, so now what we have is we have the earnings for the last 10 years minus 2020, which you can see form a much more consistent pattern. What I'm going to do is what I've done, what I generally do, and what I've done in the valuation for Apple. I'm going to add an exponential trend line. So I just want to format the trend line because it's currently linear, and I'm going to change it to exponential. What I'm also going to do is I want to come over here and I just want to look forward 11 years, because now what I'm looking for, I need to fill the missing data point from 2020, plus what I'm trying to ultimately get to is what I think the earnings per share will be in 2030. So I'm going to forecast it out 11 years, and as always, I'm going to display it on the chart, display the equation on the chart. So what you're seeing now is you're seeing a chart that uses the 9 positive earnings per share data points to predict out 11 years into a expected earnings per share in 2030. Okay, so now the question we have to ask ourselves is if Disney will return and align itself to this trend line, and when. And once it aligns itself to this trend line, then we can continue on with the valuation as normal. It's important to note that even a company with consistent past earnings results still needs research and understanding. Past performance is no guarantee of future results. That's why we need to understand the business so we understand why people will continue to buy its products or its services long into the future. We need to understand what competitive advantages it has and how they're going to protect its future earnings from competitors. We need to know that the company has honest and capable management team that will reinvest those future earnings into things that will provide as much future value for the shareholders as possible. Only if we know all of these will we be able to make a confident prediction on the company's earnings and be able to determine a fair value. Okay, so let's move on to Tesla. Okay, I've done the same thing and copied their last 10 years of EPS results into the Excel sheet. What you're going to see is, like Sam said, they only have one positive year's results. This actually limits us from being able to use the chart method or the compound annual growth rate equation method for calculating the expected annual growth rate. This means that we were reliant on the analyst predictions and our own research to establish a growth rate that we expect over the next 10 years. All right, so I've done what I can. I've gone through all of the analyst reports. I've done my research on what my expectations for the electric vehicle market will be over the next 10 years. And I've put a very optimistic view on Tesla growing. And I've used a 41% compound annual growth rate for its earnings over the next 10 years. Just to put that in perspective, that means that Tesla will double its earnings every 2 years for the next 10 years, or 5 doubles. That's very hard for a company to do, especially over that length of time. But like I said, I'm trying to be optimistic. So using the 58 cents per share that it earned in 2020 and growing it at 41% over the next 10 years, you come to an earnings per share of $18 in 2030. Now we need to apply an anticipated price to earnings ratio. So this is how much people are willing to spend for every dollar of earnings. The stock market average over the last 100 years is about 15, but the more growth people expect in the company, the higher the PE ratio generally is. Again, I'm going to be very optimistic and say that the PE ratio is going to be 50. So this means that not only is Tesla growing at a whopping 41% over the next 10 years, but we are still expecting future growth once it hits that 10-year mark. Remember, we're trying to find the value of Tesla in 2030. And in 2030, someone will be doing a very similar valuation as to what we're doing today. They will be asking themselves, how much will Tesla be worth in 2040? And for them to pay 50 times earnings, they better see a lot of future growth potential. It's very hard for a company to grow at those kind of rates, especially for that period of time. But my friends are all calling me a perma bear, so I am trying to be optimistic. Okay, so applying a PE ratio of 50 to our EPS of $18, we get a share price for Tesla in 2030 of $900. Wait a minute. I've been incredibly optimistic, and that's basically the same price that Tesla is trading for right now. And we still need to discount it back by our expected rate of return over the next 10 years. Okay, so I'm gonna go a step further and only require a 10% return over the next 10 years instead of the 15% return that I generally look for. Now, it's important to understand that the smaller the rate of return that you're looking for, the more that you can pay for it today to achieve that rate of return. It's also important to remember that the stock market average over the last 100 years, including dividend reinvestment, is about 10%. So all I'm looking for by investing in this, what I would consider a risky business, is just to match the return that I would get if I stuck my money in an index fund that tracks the overall market. But I digress. Back to the calculation. Okay, so I'm going to take the $900 that I think that Tesla will be worth in 2030 and discount it by 10% back to today's price, which gives me $347. So I'm going to do something that I never do and be willing to buy it at full value, hoping that none of my assumptions are wrong. See? Optimist. But unfortunately, Tesla is trading well over $800, so I'm not going to be able to buy it today. Okay, so it's pretty hard to feel that Tesla is a good buy at today's prices. Even Elon Musk sent out a letter to his employees warning that at these valuations, they had to perform beyond perfection and that any slip up would be catastrophic to the stock price. Okay, so $347, that is my valuation on Tesla stock, and I am being incredibly optimistic. But please feel free to leave a comment below, tell me how you see it and what you would change if you were valuing Tesla stock.
Don't forget, we also like to ask ourselves if one of our super investors is invested in this company.
Yeah, so we'll jump over to Dataroma and check this out. Okay, so I've come over to Dataroma. I'm just going to type in Tesla's ticker symbol and hit enter. And that brings me over to the ownership count. And what we're seeing right now in Dataroma is that currently none of the super investors that Dataroma tracks currently own Tesla. If you look at the last 6 months, there has been 0 buys, but quite a bit of selling. So what it looks like is that the super investors agree with us that Tesla is currently overvalued. Okay, so what I would normally do after this is I would jump over to SEC Edgar. This is the official filing for the super investors, and I would just validate this data. But in the essence of time, I'm not going to do that. But I will leave a link in the description below to SEC Edgar. So it's a great site to go and peruse a bit.
Okay, so we recently discussed using options to enter into an overpriced stock.
Yeah, so we'll jump over to Thinkorswim platform and see if we can use options to enter position in Tesla stock. So here's the option chain for Tesla. I'm generally looking to sell put options with about a month left to expiration. So I'm going to go over to the 19th of March expiration date, which is 35 days from expiration. And if I open it up, here is your options chain. These are the options that you have available to sell or buy on Tesla stock. So if I was confident that Tesla could grow its earnings 41% a year for the next 10 years, and that there was still going to be enough growth left in the company for somebody to be willing to pay 50 times earnings for it, and if I was willing to accept mere market matching returns and be willing to pay full value for it, I could sell the $348 strike price put option. So if you come over here, the $348 put option currently has a premium of $1.29, roughly $1.30. Okay, so generally when I'm selling put options with about a month till expiration, I'm looking for premiums to be about 1% of the strike price. And this is because I'm looking for at least 15% return annualized on my money, even when selling puts. So looking at the Tesla option chain, it's just not getting me there. And it means I'm going to have to wait till the market brings the price closer to the strike price that I'm looking for, to the price that I feel is a fair value for Tesla. Okay, I like being optimistic, but it's not enough to get me to invest in Tesla at these prices. It doesn't mean that Tesla won't double tomorrow, but it won't be based on the company's fundamentals, and I rely on these to prevent me from losing money. So I'm gonna move on to something else. And that brings us back to Sam.
All right, guys, that's it for us for this video. We hope that you enjoyed it and found it useful. If you did, be sure to like this video, or better yet, subscribe to our channel. We love to hear from you, so please feel free to share your thoughts in the comments.
Remember, earn more, spend less, and invest the rest. And we'll see you next time.